Our panel is titled New Financing Techniques Using Digital and Blockchain Solutions and Platforms. I'll be moderating the panel. My name is Lily Tesler. I head the blockchain and fintech practice at Sidley Austin, working with a variety of blockchain companies from issuers to trading platforms, cryptocurrency exchanges, broker-dealers, supporting digital asset securities exchanges, securities offerings, and custodians in the digital asset space as well. Without further ado, I'll introduce our speakers today who will give a little brief overview about their background before we jump right into the questions. So first we have James Rowe from Intoro Capital.
Thanks, Lily. Jim Rowe, founder, managing partner of Intoro. Intoro is an investment bank, broker-dealer, RIA, and a valuation service based in Houston. My own background comes from the energy sector myself. I've been a oil and gas operator. I've been the CEO of a public Australian oil and gas company. I've worked for a number of public merchant energy companies. So I guess even our own shop was started from an acquisition of a energy shop. Intoro Securities was actually originally the oil and gas asset clearinghouse's broker-dealer. So our genesis was actually from the energy space. So look forward to everybody's questions on blockchain and digital securities. Pat?
Great, thank you. And next we have Pat LaVecchia from Oasis Pro Markets.
Great, thank you, Lily. Good morning, and once again, I'd like to thank Lori and for inviting us here to this terrific conference, and things are starting to get back to normal, which is really exciting. Pat LaVecchia is CEO of Oasis Pro Markets. Oasis Pro Markets is an investment bank as well as a digital security ATS, which we'll talk a bit about a little later. But basically, digital cash for digital securities. And with what's happened with crypto this morning, we'll talk a bit about that as well. My background, just a quick snapshot. Investment banking for close to 30 years. I used to run private equity placements globally at Bear Stearns, then at Credit Suisse First Boston, and then I ran capital markets for First Horizon before starting my own broker-dealer, which I ran for about 10 years before I brought in outside investors and started Oasis Pro Markets. Thank you.
Great, thank you. So to start off, we'll start a bit, some general questions regarding blockchain and then dive into some of the financing techniques we want to discuss today. So first, I'll start off with how can blockchain technology benefit the energy industry generally, given the audience here?
Sure. Peer-to-peer transactions in regards to trading. There are already a couple of trading platforms out there using, when we say blockchain, also digital ledger technology, which is immutable, so that the settlement times are almost instantaneous if it's fully on-chain. So that's one of the biggest benefits of the energy market. We'll get into discussing how energy companies from a capital raise and a savings standpoint can also benefit from DLT. But at the very top of the list, I believe, is the peer-to-peer trading. Jim?
I would also add that there's a huge advantage from an audit standpoint as well. I don't think you can overlook the ability to go back and track things. So when you're conducting that, both from a financial and a regulatory standpoint, there was actually one energy company I'm familiar with that was able to, some people may not like this, but was able to reduce headcount in one particular accounting group by 85% because they were able to standardize, modernize their particular operations. So that was a huge benefit to them. And when it came to the regulatory aspects of it, able to standardize their output and have a huge pickup in their quality and results. So the risk of reporting also went down. So for them, it was a huge pickup having everything on a DLT, distributed ledger technology.
Yep. And we're seeing some of those benefits across different industries, but certainly energy is one of those growth areas. So are there particular use cases or applications that each of you are seeing in the energy sector?
They're developing. In regards to, I'll give examples rather than company names right now, but some examples are MLPs in the energy sector could benefit from DLT, and we're in a number of discussions right now with publicly traded DLTs. The cost savings that Jim just discussed in regards to the 85% reduction in head count, what we estimate is for coupon payments or dividend payments, utilizing DLT could save anywhere between, for dividends, 20 to 35 basis points in cost savings on the back office aspect of it. Basically, the CFO can press a button on his computer and almost immediately have funds transferred. Now, the downside is there is no carry. The benefit of carry of that cash, but there is, it's completely auditable. And again, it's tied to DLT. In regards to coupons, we estimate that the savings for any company on the issue size are anywhere between 25 and 50 basis points, which is quite considerable as you think about it. And again, all the control aspects could be handled out of the treasurer or CFO's office. So we're in a number of discussions with companies, public companies, some of which are here today. And but we at this time, I'm not at liberty to mention names.
Great. So now shifting gears to digital asset securities or digital securities. What are digital securities and how are they being regulated in the U.S. right now? If Jim, you want to start that off?
Well, there's been a lot of misunderstanding on what really digital securities are. In fact, I would say the regulators had a huge misunderstanding of what a digital security was at the very beginning. And in fact, digital security is nothing more than an electronic version of paper. So if you had an equity issuance, digital asset for the most part is just the codification of that equity or debt representation. So it's no more than if you were to issue for example, a Reg D 506C equity offering, and instead of handing somebody a piece of paper with their ownership, you would literally have it in a digital format. So it's almost a little bit, it's a bad example, but almost like street name in your own stock. If you have your stock account or your equity account in your brokerage account. So it's a little bit like that. So there's a lot of misunderstanding, but at the end of the day, instead of just having it in a simple spreadsheet, most digital assets are in a blockchain format, and they would be put into a digital wallet. And it's just a form of digitization on the blockchain. And the blockchain just allows you to have an immutable record of that transaction. So really, it's a lot safer, it's a lot easier. And in the future, just about everything is going to be blockchain. And 5 years from now, we won't even mention the phrase blockchain because it'll be part of our lives, and it'll be something we don't even really discuss just because it'll be out there. But back to what is a digital asset? It is really just the codification of paper on the blockchain.
So first of all, I'd like to say I love the regulators, and they're some of my favorite people. But we're on the phones with the regulators all the time. I completely agree with everything that Jim said. But this is an evolution, not a revolution, from a digital asset standpoint. So look at, if you recall, the market was T+7 in the 60s, moved to, this is just for equities, and T+5 in 74 with the onset of DTCC. Fast forward to the early 90s, trade settlement +3. Fast forward to about 3-4 years ago, trade settlement +2. DLT is basically trade settlement plus seconds, milliseconds, and we'll eventually get there. I agree. In five years, maybe 10, we'll look back and say, what was the big deal? The regulators are taking a deep dive. But it's such an education process. We've been going through to get our ATS approved. It's been about a year and a half process, a little longer. And I've seen a tremendous growth and of knowledge base in the blockchain crypto space from the regulators. They've been hiring a lot of industry people, which is fantastic, who can speak the language and actually understand the underlying. But they still don't view the blockchain as an immutable record. So they look at the 33 and the 34 Act here in the US, at least. Other countries, other jurisdictions have completely revamped their guidelines. We in the US have not. So they look at the 33 and 34 Act guidelines, and then it's basically a square peg in a round hole. And they're trying to retrofit with, if you're familiar at least with equities, you need typically a clearing firm, transfer agents, and custodians. And that's what they want to see. They are slowly moving forward, and we think there's progress, but there's very little guidance. And now with Gensler as the new SEC chairman, there should be some progress. It'll most likely be it'll be regulation by enforcement than actual regulation, but we should see some progress going forward. To Jim's earlier comment, I would just like to add that when you think about this wrap or codifying of securities, as Jim had mentioned, it's a security, but it can be almost anything. And that's the beauty of digital securities, digital assets. So it could be royalty stream. It's basically all tied to a smart contract. And I'll just briefly discuss that. So what's a smart contract? It's basically coding. So you can set up an equity security, for instance, even if you're a publicly traded company right now with no voting rights, just as an example. It trades on the blockchain. It trades on an ATS, for instance, ours or others. And it has a set of rules that you can code into that smart contract. Now, that smart contract can be upgraded, but it can't be changed. And I believe the regulators have gotten comfortable with that right now. But what really excites me, and I think Lily and Jim would agree with this, is you could do almost anything. And in regards to a type of security, because it's all based on coding at the end of the day.
Thank you both. And I just to add, I think just for those in the audience that are not familiar with all the evolution of regulation coming out of the SEC, the confusion, or at least the reason they're concerned, is that the definition of digital asset securities that they've created, both on some of the securities guidance, the SEC guidance and FINRA guidance, is so broad in that it captures these digital versions of equity that we've been describing, as well as a lot of the cryptocurrencies that have been offered under Reg D or other private placement exemptions that would fit that definition of a security under investment contract concept. And so the definition is so expansive in that the SEC is trying to provide for both scenarios in their guidance, and is what's causing some of the confusion and concerns from the regulators. And I think it's not driven as much for equity like digital securities or debt as it is for some of these investment contract concepts. So next wanted to dive in a little on the institutional marketplace. Do you think we'll see strong interest, or are you seeing strong interest in the digital securities market from institutional client base or customer base?
I would bifurcate it between U.S. and non-U.S., frankly, from my experience. The U.S., both from a regulation and a interest level, is significantly behind the rest of the world when it comes to digital assets and digital securities, and also structures, which is kind of sad. But from a regulatory standpoint, I would say we're significantly behind. From an interest level and product development level, we are also, I would say, at least a year behind the rest of the world. So from an institutional side, I would actually say it has less to do with, whether or not it's retail or institutional. I actually would say it's more geographic than anything else, maybe regulatorily and, regional. But it's in the U.S. It's more, if it's not broke, why fix it? Where in other jurisdictions and other locations, it's more they don't have the products, they didn't have the type of structures. They were more nimble. They could do things. They were more innovative. They were doing it because they had to. So you have a different kind of interest, particularly in the Asian market. You're seeing a completely different type of product mix. We're working on a number of structures in Asia that you won't see in the U.S. for probably another year or 2 years. So I don't look at it as something that's institutional or not. And then in the U.S., back to the regulators took a punitive aspect to it in the U.S. instead of a openness, and they were penalizing people even to take a look at it. And so I instead of trying to be proactive in a lot of cases, the regulators a couple of years ago took a very different view, whereas the rest of the world, they were much more open about it. So the markets are developing differently. So institutionally, better outside of the United States, and it'll just take a little bit longer. I turn it to Pat. I guess he may have a different experience, but for me, it's much better outside of the United States.
Now, I would agree with you, but there is a growing interest. So it's really Bitcoin that started from our experiences. Institutions were very interested in Bitcoin today. Hopefully, they'll be even more interested because there was a huge price drop, over the last 10, 12 hours. So it's a buying opportunity. And then they started looking at ETH, and the difference between the two, just simply, if you're not familiar with crypto, the way I view it at least is Bitcoin is more like a commodity, like gold. And now the question is, it's not physical, and that can be argued all day, but that's how it's being traded right now as a commodity from an institutional standpoint. ETH is more like an app where there's a whole area of crypto called DeFi, or decentralized finance. And I would say the overwhelming majority of those particular companies are built on the Ethereum blockchain. And so ETH basically allows those companies to develop their protocols, but they're all built on ETH. ETH is also how transactions on the blockchain are paid to the miners. They're called gas fees. So ETH and Bitcoin are very different. And if you just think of it as a app store for ETH for Apple or Android, I think it starts making more sense. Now, it started with Bitcoin. It's moved to ETH. There are a whole host of other tokens that are being viewed. And now digital securities and digital assets are being introduced. And one of the most exciting aspects for institutional investors is there's almost zero counterparty risk. So because settlement times can go to, I've said T plus seconds, our particular ATS can do OTC public equities, so T plus seconds there. It could also be T plus an hour, but it's certainly less than T plus 1 day. And with that zero counterparty risk, that gives a lot of comfort to the institutional investors. The issue for digital securities right now is liquidity. And we'll talk a bit about this later in regards to how that will be improved, getting more into the market. But the way I view digital assets and digital securities right now is where crypto was 3 to 5 years ago. And there's more and more interest in it. And in about a year's time, I think it'll start really building. But it's a great opportunity for companies in the energy space who are looking to raise capital as well. I'll give you an example. For our particular ATS, you can actually use stable coins. And again, I apologize, I'm using these terms if you're not familiar with them, but think of stable coins as basically being targeted to $1. So it's $1 in crypto. And there are a variety of them. There's DAI, there's PAX, there's USDC, and there's Tether. And the market cap, I think, of just those handfuls I've mentioned right now is close to $100 billion. So it's not a small market. But through DeFi, what you're able to do, if you're a large Bitcoin holder or ETH or one of these other tokens, you can actually collateralize your specific holdings. So you don't have to sell them, so there's no taxable event. And you collateralize, pay a relatively low interest rate, let's say 4 to 6%, convert it into stable coins. Then with those stable coins, you'd be able to go and diversify your holdings on a digital security, digital asset exchange by buying ETFs when they get approved, an MLP that you're interested in, whatever it may be. So another opportunity here when we talk about institutions and their interests, where we're talking about traditional moving into the digital space. Well, there's a whole host of crypto investors out there that are interested in diversifying and moving, somewhat bridging back into the traditional space from an investment standpoint. So that opportunity, I think, is great and could open up a new market for a lot of energy companies.
Great, thanks, Pat and Jim, and also just to add, Jim's point about having a lot of interesting products in non-U.S. markets. I'm seeing that trend as well, and it's not that U.S. Market participants aren't interested in that area. I actually have a lot of clients that see these innovative products, see these offerings outside the US, and are trying to figure out if they have non-US affiliates that are able to take advantage of these buying opportunities. So the US entities are not left behind at a later date when the US has caught up in terms of the products and regulation investing in these products. So there's offshore arms of some of the US companies looking at those non-US opportunities as well. Just also speaking about digital securities, we have a number of public companies in attendance here today. How are public companies thinking about investments in digital securities? How can they take advantage of this phenomenon? Jim, maybe we'll start with you.
I'm working with one public company, and we're actually working on a off-balance sheet structure to take a commodity and create, it's almost like a vending machine. So using the commodity in a commodity-backed token and using that structure, basically putting this commodity into I'll call it a bank, and that's a bad word because you shouldn't use it that way, but we'll call it a vending machine. So basically put the commodity into a vending machine, create a prepaid token, and when the buyer of the token wants that commodity, they literally would, go and put the token into the vending machine and pull out the commodity. And this is it's going to end up being a massive transaction and a global one, actually. So it ends up being it's going to be an off-balance sheet transaction, but it's going to be able to monetize a particular commodity. You'll be able to start to trade it differently. It'll have a global exposure. You'll be able to do something. It's structured finance. So at the end of the day, it's going to be something that will have price transparency. You'll have all the features and benefits of an off-balance sheet transaction. You won't have to use, typical issue of being off-balance sheet. You won't have the issues of the financial issues on your financial statements, et cetera. So you're going to start seeing some innovative structures coming down that weren't typical or used here a few years ago, but the mechanics of digitization are going to be able to enhance it, make it easier, and be able to transact faster. And it'll give people that comfort when they have actually the possession and ownership of a token to be able to move it faster. And they'll eventually be able to trade it on an exchange like Pat's ATS. So it'll actually end up being there'll be a lot of transactions that go very, very fast, and these things will move quite quickly. So you're going to start seeing both public and private companies using these transactions. That was just one example, but you're going to start seeing a lot of these kind of, it's going to be merchant energy, 2.0.
Great, thank you, Jim. Just to one housekeeping item, to announce the Slido code for the people in the room today. The code for this session is 0519 BRKFST. So that's 0519 BRKFST. So following on to Jim, your point about the ATSs, we had a question from the audience also is maybe I'll hand this off to you, Pat, is how will, we understand there could be trading on ATSs, but how will this impact exchanges such as the New York Stock Exchange or NASDAQ for public markets?
Great question. I'll give an example. Eventually, they will move into this space. We have had a lot of discussions with both groups. New York Stock Exchange invested in Coinbase in 2014. And it was, think of Coinbase in 2014. I think they put in $2 million. I don't know what it's worth today, but it's worth a lot. So they'll dip their toe in a variety of different companies, ATSs, ideas, and then eventually, what I imagine is that they'll move full bore into this particular space, but they have to go through a regulatory process as well, like we did and others. They can't just shift it on in a day. But they're like, they're like aircraft carriers anyway. When new innovations comes, they don't move quickly, but they do invest. Look at what Coinbase has done in the crypto market. I think their market cap is about 60, 75 billion, something along those lines. About 5 years ago, they had little to no revenue, and their latest raise was about $480 million. A Morgan Stanley, an exchange, could have swooped right in and bought them, or started their own competing exchange with what Coinbase did. But since it was novel, overall, it was a small part of the market. They didn't do it until it becomes significant enough for them to take action. So I think eventually both New York Stock Exchange and the NASDAQ will jump into this, probably be in 5 to 10 years. We discussed earlier, just the benefits are just so obvious for both the institutions, but the issuers as well. Some of the items we haven't talked about as to why issuers would want to do this is cap table management. So if you're a private company right now, paperwork is a nightmare if there's any trading of your private securities. Well, through DLT and blockchain, you will know on a daily basis exactly what all your investors own of the company from a cap table standpoint. Fixed income securities, preferred securities, whatever securities you might have, you will have that information on a daily basis. And that could be quite powerful. For public companies, that is available as well, but we would expect that institutions really don't want companies to know when they're selling or buying. So it still may be in street name like it is today, and then you hire an outside service to figure out who actually was doing the buying and the selling. But the advantages are amazing, and I can share our discussions with NASDAQ and New York Stock Exchange are very positive. They all have digital groups exploring this area, so they will be players.
Mm-hmm. Yeah, and one other component to add, we talked about issuers and exchanges, is clearing agencies. So DTCC has issued a number of white papers regarding distributed ledger technology and blockchain and some of the benefits and risks related to that. But we're also seeing competitors come in to disintermediate DTCC as a clearing agency. For example, Paxos Trust Company got no action relief from the SEC to operate a 2-year test technology to effectively clear and settle publicly listed securities with existing registered broker-dealers using Paxos's proprietary clearing technology, and have since that approval now are in the process of seeking clearing agency registration. So we need the entire trade flow and infrastructure to be on distributed ledger technology, and there are a lot of benefits across the trade flow that we're seeing in this area. I don't know if either of you have anything to add on the clearing side, because I think that's an important component to the entire infrastructure.
I think you're going to see that throughout the whole financial services industry, both from clearing, you're going to see it from the transfer agent side, the custodial side, you're going to see it. There's going to be, I disagree with Pat on one area. I think it's not going to be 5 years. I think actually Coinbase gets absorbed in 2 years. I don't think it can I don't think the markets can take that long. I think you're going to see a wave of consolidation here because they have to. But I believe all of the aspects of each one of those cases, so clearing, transfer, custodial, all of them are going to go to a digital format because they have to from a competitive standpoint, also from a cost standpoint. I mean, there's just the issues are just too compelling that they have to. There's just so many issues why they have to. But at the end of the day, there's going to be a massive consolidation, and it's going to also be a massive reduction in the number of service providers as well. So you're going to go from, just like the number of broker dealers that have been in the reduction, just like the number of oil and gas operators, the number of pipeline. I mean, everything is going to get reduced significantly. If you look at the BD world, you've seen effectively a 75% reduction over the last 15 years. You're going to continue to see that. The custodial world, you're going to see the same thing. Transfer, it's just going to be all of that, and it's going to be just on cruise control with blockchain. So if you want to talk about clearing and settling, you're more of an expert than I am, Pat.
Thank you. I would just add, I agree with those points. DTCC is a very important player right now in the traditional market, but they've come out with Project Whitney and Project Ion, and now is not the time to go into detail on it, but it's basically their approach and suggestions in regards to incorporating DLT and blockchain into the clearing and settlement process. And they're making a lot of strides. Now, for DTCC to be spending time on this, devoted resources, just shows you that the large players are not waiting for the regulators. They're moving ahead with these projects and then going to the regulators with demos, demonstrations, and discussions in regards to this is where the market should go. So with PAX and DTCC, I think they can coexist. Mm-hmm. Jim may be right. There may be a consolidation, and DTCC just takes over PAX at some point. I mean, who knows? But I welcome DTCC. They give comfort to the institutional investors. They give comfort to the issuers. They give comfort to the regulators. And for such a large organization to be taking digital assets so seriously across the board, and they're not only thinking about equities, they're looking at fixed income as well, that I think it'll really enhance this market when they are able to get through the regulators with their concept. And just quickly, Project Whitney is an approach. There's a white paper out regarding private securities. Project Ion is for public securities. And fast forward, they came out about a year and a half ago. Fast forward, they are now combining both and exploring if some of the aspects of Project Ion and Project Whitney can be combined.
Great. So shifting gears towards tokenized assets, which is a bit different than digital securities. Jim, what types of projects are you seeing in the tokenization space for energy?
Well, first of all, the word token is usually persona non grata with the SEC, so we always try to avoid that. But so when you're doing a project and you're having an interface with the SEC, try not to use the word token. But if you are going to tokenize a project, we're working with one in the mineral space. So you can literally have a tokenization of the minerals assets as well as the payments of the royalty payments. So you can actually tokenize a minerals project, a royalty stream as well. So that is one example of using and doing tokenization. So to Pat's point earlier, it's not just issuing an equity aspect. So you can tokenization, digitization can be both from a equity raise, it can be a debt product, it can be, but any cash flow stream can also be done on. You can also capture on the blockchain, rights. You can do waterfalls. You can do. I mean, there's all kinds of things you can do in a normal structured finance concept can be done. But from tokenization, some of the things that you will see will be more in the trading side. But I think you're going to see a lot of neat things coming out in the mineral side because it's an easy thing to do because you have the ability to capture royalties and the payments, and you can do things that are going to be real neat as far as monthly pay structures, et cetera. So, and it's going to be clean, and it's going to, just like the digitization of the courthouse, you're going to start seeing the digitization of minerals, and it's going to really be fascinating to see over the next year or two.
And just to add, the reason why Jim says, don't say tokens to regulators is there's a presumption that when you say digital or token to, for example, the SEC, they'll assume it's a security, or you have to then overcome that presumption. While putting something on a distributed ledger technology doesn't necessarily make it a security. It really is just a digital version of what that asset represents, either a physical or intangible asset. And so you still need to work through those regulatory issues on the security side, commodity side, various, even the banking regulators are concerned about anything digital, and does it impact money transmission laws? Does it become a convertible virtual currency that's subject to FinCEN or other state banking regulators? So there are a number of regulations that are triggered by putting assets on a blockchain technology from each of those regulators, even though if that asset were not on this technology, those regulations in normal course would not even be considered. So it's a pretty broad array of things to consider in this space, especially if you're tokenizing assets. But I just want to give some backdrop as to why not to mention tokens, although the questions will likely arise regardless from the regulators, even if you call it something else. So one other topic that is very timely and not necessarily talking about financing in the blockchain space, but there's a lot of news and discussion in the press regarding proof of work blockchains, specifically Bitcoin being one of the most well-known proof of work blockchains, and it's consuming an enormous amount of energy, and how that may impact the energy space. I figured, given all the discussion of it in the news, as well as the substantial fluctuations of Bitcoin pricing as a result of that in recent days, wanted to get your perspectives on that.
Sure. Well, I think that a lot of this was put into the mass media by Elon Musk's comments recently regarding Tesla no longer taking Bitcoin because he had discovered it was not ESG compliant, and Tesla is viewed as an ESG company. So he wanted to be forward thinking about that. But I think it's actually not accurate. It does use a lot of electricity, but we were discussing earlier how there are benefits for repurposing coal in regards to what happens with the miners. And miners are the ones who basically confirm that a transaction can go through. When I said there was zero counterparty risk, there's all these steps. Typically, it's anywhere between 50 and 30 different miners confirm that particular wallet address has those securities or assets, digital assets, or has that crypto, be it Bitcoin or whatever it may be. So it is somewhat expensive. But what I'd add is going back to Ethereum. Ethereum is about to come out, and think of it, this is a completely decentralized organization. So you have coders, you have members of the community who are auditing work from other coders, and there's this aspect called Layer 2 that is expected to come out by the end of the year. And right now, these gas costs have gone up because the use of crypto and institutional interest in trading has gone up. So whereas maybe a year and a half ago to do a transaction of $100,000 may have run you, I don't know, about $30 or thereabouts. Today it's probably in the low thousands, like 1 or 2,000, maybe as high as 3. But think of it as a highway, a 4-lane highway right now. That's why the costs are going up. And who's ever willing to pay more gets access to the highway prior to anyone else. With Layer 2 coming out, the cost of electricity will go way down because that 4-lane highway now is going to be a 24-lane highway. So those gas costs are going to go down quite considerably, and it also will have an impact through this proof of stake on the electricity usage. So same amount of electricity, think of it for that 4-lane highway, may now be a 24-lane highway or a 48-lane highway, and that's coming. It was targeted to come to the market in 2019, and then it's been delayed by 6 months to a year. But right now they're going through the auditing process, and it should be achieved by the end of this year. So there's a lot of movement with the concerns about ESG and electricity usage. My sense is that Elon, in a couple of months, will probably reverse that particular view.
You took a very positive spin to that. I'll take a little bit different spin to it. Elon's the greatest marketer of all time. He pumped it up for his own benefit, and God knows how many shorts he had on the backside. So, and since it's not a security, he can do whatever he wants. So, my mind was it was purely a financial trade for him. So, it is what it is. But a lot of people also don't understand the difference between proof of stake and proof of work. So, most of the cryptocurrencies and most of the activity out there is proof of stake, not proof of work. So you're going to start seeing a lot more coins, a lot more of the digital activity on the proof of stake side. So, Bitcoin is the biggest one on proof of work. So that is going to take its own course. So I think you're going to start seeing a lot of things that are different. There's a lot of proof of work organizations out there. You're seeing a lot of organizations, a lot of groups doing renewable mining on Bitcoin. So you're starting to see that transpire. So you're going to start seeing a different kind of a play towards Bitcoin mining. So I think you're going to see different things. But as far as actually an ESG and having a positive, I think there's niche plays out there that are actually going to be beneficial, not necessarily negative. Now, does it use a lot of electricity? The answer is an emphatic yes. But there is some positives to it as well.
Yep. And I would echo that in that there are a number of Bitcoin mining companies that are already public and have ESG disclosures in their public documents as required by SEC disclosure requirements, and a number of others that are in the process of going public that are considering this particular issue as part of their kind of development of their business going forward as well. Next is how could blockchain provide better data privacy and best-in-class security for projects in the energy space, and especially in light of recent hacks or security concerns in this area?
You want to take it, or? Well, I think we go back to the same subjects. Is that when something is on a blockchain and immutable database, it's a little harder to hack, frankly. So you have a lot more security protocols. Anything can be hacked. I don't care what anyone says. Things can be hacked. Whether or not it's a 12-year-old boy in a basement in some place in California, or Ukrainian hacking group, it can be hacked. It's just a matter of time. There's just better protocols, better security if you have immutable databases and activity. So you're going to start seeing, if you're not Colonial, your other energy companies are going to have to beef up. I know ourselves as a broker dealer and an RIA, we're constantly worried about the attack of the cyber issues. If you talk to anybody in the financial services business, there's community banks I know that are getting hit 30,000 times a week by hackers. It's just, people are constantly getting hacked or penetrated all the time, or at least being threatened and hit. So I don't think that's going to go away. I think the whole process of what we're looking at is just going to improve constantly, but there's no perfect solution.
So just along those lines, I think it's important to note that two aspects, and I should have mentioned this earlier regarding institutions. One of the biggest issues before institutions really came into the market was custodians. Custodians are a very important part. So right now, if you have a self-custodial wallet, you've got this cryptography address, and if you send it to the wrong address, you lose all your money. And we've all heard stories of a Bitcoin millionaire or billionaire losing their wallet address, and they can never get it back. The custodians have stepped into this market. I'll mention a few: Anchorage, Prime Trust, BNY Mellon, State Street have invested in the area. We know that they're taking Bitcoin and ETH right now for their customers. Eventually, in their timeline, they plan to take digital asset securities. Fidelity is doing the same thing. We're having discussions with all these groups, and they're all very forward-thinking along those lines. But one of the really interesting aspects from an issuer standpoint is, while crypto can be hacked, and you hear that someone lost their account, or through fraud, somebody took their crypto, and that is what it is. That's just the nature of the beast on that side. For digital asset securities, if you're an issuer, and for whatever reason that there's fraud, the issuer can act as transfer agent for both private and public securities if they choose, or to utilize an existing transfer agent. If for some reason someone's securities were stolen, very similar to the process now with traditional securities, but this is all on in a digitized format. The stolen securities could be burned. So once they're burned, they can't be transferred to any other party, and then the transfer agent can actually reissue new securities to the harmed party. So some of the risks that you're hearing about crypto don't necessarily convert to the digital security space. And the regulators are very comfortable with that. That was one of their first questions when we started this journey, was what happens if somebody steals a digital security? Well, there's a process in place right now for traditional, and it's being converted to the digitized space.
Then I think we have one last question for the panel. How does blockchain allow for consumers to buy and sell excess energy from other consumers? Is that something that you're seeing, or?
Want to repeat the question?
So how does blockchain allow for consumers to buy and sell excess energy from other consumers, or at least, how could it create that capability?
Can I answer one of those questions?
Sure.
I'm not really sure that question. I mean, I'm
Okay.
not sure we.
Well, maybe another. When will energy industry participants, will we see them accepting cryptocurrencies generally? And I know one of the questions to the audience is what are stable coins? Maybe that's something that they'll
let me
be
go
able
to maybe
accept.
on the acceptance of cryptocurrency or other payment structures. I think you're going to see some of that transpire. I don't think you're going to see a rash of organizations accepting multiple payment streams.
Mm-hmm.
I think it's a little bit overblown. You saw Tesla saying that they would or would not take Bitcoin. You've seen certain car dealerships in the Houston area say they would take Bitcoin, and now they're not. So I think it's like FX risk. Are you going to take US dollar, or are you going to take Japanese yen? You're going to take the euro. It ends up being a problem. I mean, it ends up being, then you have conversion issues, all kinds of things. It just becomes more of a pain for a lot of people. It's kind of cute and kind of gimmicky a little bit, but at the end of the day, you still have to function for the most part in fiat, meaning currency, a state issued currency. So I'm not so sure it's actually going to be that prevalent. You're going to see some things that become stable coins and convert to that. I think you're going to see in various jurisdictions where your currency isn't worth much being much more prevalent, but in locations where you have the dollar, the euro, et cetera, I don't think you're going to see that much as far as that happening. But if you're in Brazil or places with hyperinflation, well, maybe the U.S. ends up that way. But in other locations where you have the currency is not worth much, you will see other payment streams. But I don't think you're going to see that much happen as far as other payment streams. But Pat, you can opine.
Yeah, just very quickly. I know we're running out of time here, but so while before we came up on stage, Bitcoin went up in value 20% over a 15-minute period this morning. So Bitcoin's very volatile. Why stable coins? Stable coins are a form of, think of it as crypto fiat because it's at $1. So I think to the Tesla, when, the Tesla example we gave with Bitcoin, well, Bitcoin yesterday was at 42,000. This morning, at one point, it was at 32,000. And if I want to go and buy a Tesla, yesterday I could buy it, today I can't, right? With that one unit. Now, if I had converted that into stable coin, it would be at that $1. So be it USDC or DAI. So that's how you should think about stable coins. But just one last thought for people in regards to this space. The groups that we're speaking to are very forward thinking. The public companies that we're speaking to are very forward thinking. So we do have a number of tech companies, as I mentioned earlier, energy companies, specifically MLPs, and other areas in different types of funds, very interested in this space, and they're dipping their toe. So if you're a multi-billion-dollar issuer, public company right now, for instance, and you want to do a $50 million fixed income offering on the DLT, the risk is very low, but it's an opportunity to see if these cost savings that I had mentioned earlier, 25 to 50 basis points, are real, and if you could benefit from it. So that's where I think you're going to see a lot of movement, is forward-thinking issuers who will be dipping their toe in terms of a variety of different offerings and experimenting in the digital asset space.
Great. Thank you. Thank you for having us today.